What if I told you that you could own a piece of Singapore's biggest companies like DBS, OCBC and Singtel? It's not just for the wealthy. You don't need a fortune to start investing. It is for anyone willing to learn. Let me show you how you can go from being a customer to becoming an owner of these companies, potentially earning returns that no savings account can match. Imagine seeing your money grow while you're still working at your full-time job or while you're traveling, spending time with your loved one. Doesn't that sound empowering? In this video, I will break you down for you to understand what are Singapore stocks, why invest in Singapore stocks, how to get started, key tips for beginners, key metrics to understand, strategies, and my takes. Stick around because I will also review the number one mistake new investors make and how you can avoid it. Trust me, these tips alone can save you thousands of dollars. So grab a coffee, hit the subscribe button, and let's get started. What are Singapore stocks? Let's start with the basics. If you live in Singapore, chances are you already interact with the major companies, whether it's banking, shopping at the mall managed by CapitaLand, or staying connected with Singtel package. Here is a game changer. When you invest in stocks listed on the Singapore Exchange SGX, you are stepping into the shoes of an owner. Each share you own represents a tiny slice of that business, giving you a say in its success. Here is a quick breakdown of the main types of stocks you will find on SGX. First is the blue chip stocks. These are Singapore's most reliable companies like the banks, Singtel and CapitaLand. They are known for stability and regular dividend payout. Great for beginners looking for steady income. Second, growth stock. Think of this as the next big thing. Smaller or younger company with high potential for rapid growth. They are riskier but can deliver significant return. Third, REITs, Real Estate Investment Trust. A favorite in Singapore, REITs lets you invest in income-generating properties without buying the physical real estate. They are loved for consistent dividend and lower investment barriers. Why invest in Singapore stocks? First, economic strength. Singapore has a stable and robust economy. Investing here means tapping into its long-term growth. The benchmark Straits Times Index (STI), which tracks top companies, has averaged 6 to 7 annual returns including dividend over decades. Second, diverse opportunities. Whether it's finance, healthcare, or renewable energy, Singapore market span multiple sectors. Third, attractive dividends. Many companies, especially banks and REITs, are known for consistent dividend, often yielding at 3 to 5% annually, which is higher than many global markets and of course the savings account. But don't forget, every investment comes with risk. Stock price can fluctuate due to global events or company-specific issues. Singapore stocks generally offer modest but consistent capital appreciation, complemented by strong dividend yield. While growth rates may not match those of high-growth markets like in the US or China, the stability and income potential make Singapore companies an attractive choice for conservative investors. Diversification is your safety net to manage this risk. Ready to start your investing journey in Singapore? Here is how you can get started in a few simple steps. First, choose an SGX licensed broker to get started. Popular options include DBS Wickle, OCBC Securities, or UOB Kay Hian, or try the modern online brokerage like Mumu, Tiger Brokers, Weibo. Many offer attractive bonuses for new customers. Check the links in the description below for details and take advantage of them. Second, set up your CDP account. Refer to Central Depository Account. This is where your stocks are safely stored. Singaporean and PR can open CDP account easily via SingPass, while Work Pass holders can also apply. Just have your passport and other documents ready. Third, fund your account and start investing. Transfer money from your bank to your brokerage account. For first-timer, use Direct Debit Authorization (DDA) for instant and free transfer from most Singapore banks. Start small and invest. Begin with manageable amounts to build confidence. Over time, as you learn, increase your investment. Here is the pro tips. Use resources like SGX Market Data, Yahoo Finance, and Seeking Alpha to research companies and monitor trends. You may also start to bookmark these essential resources like the SGX, the official website for market data and investor tools, and financial news outlet. Stay updated with trusted sources like Bloomberg, Reuters, and local finance publications. Key tips for beginner investor. Before touching the stock market, here are 5 key principles to guide yourself. First is to know your own risk tolerance. What is your comfort level with potential losses? Stocks can be exciting, but they are not without risk. Prices can swing significantly up and down, one day up, one day down. Ask yourself, how much am I willing to lose in the short term for potential long-term growth? Given the recent dip in August and a shock in December right after the Fed cut rate, the market reacted. Would you panic sell? Are you okay with the ups and downs? Stocks might be your roller coaster, right? Second, define your investment goal. Why are you investing? Is it for retirement, saving for your child's education, or buying your dream home? Your goals determine your strategy and timeline. For example, short-term goals like 1 to 3 years, you can consider safer options like bonds or dividend stock. Long-term goals, over 5 years and above, you can consider growth stocks or diversified portfolio can help you build wealth over time. Third, diversify your portfolio. You have heard this saying many times. Don't put all your eggs in one basket. The same applies to investing. Spread your investment across different sectors like banking, tech, or healthcare, and across different companies. Of course, you can also add stocks from other countries like US, China, Japan, and others. Diversification reduces your overall risk. Fourth, take a long-term perspective. Think marathon, not sprint. The stock market is a powerful tool for growing wealth over time, but it's not a quick win game. Patience pays off. Historical data shows market generally trends upward despite short-term drop. Stay focused on the big picture and avoid temptation to panic sell during market downturn. Fifth, do your research and due diligence. Before investing in any stock, know the company, look at their financial health, industry position, and growth potential. Ask questions like, is the company profitable? What challenges does it face in its industry? How does it compare to its competitors? Stay informed is your best defense against making impulsive decisions. Now let's talk about taxes. You might be wondering, what about taxes on dividend income and capital gains from selling the stocks? Great questions. Here is the good news. In Singapore, there is no tax on those. Here's why. Dividend income from Singapore-listed companies are tax exempt for individuals because they come from the profit that have already been taxed at the corporate level. That means, as an individual investor, you are in the clear. And when it comes to selling stock, there is no such capital gain tax either in Singapore. But here's the catch. As long as those transactions are not part of trading business. If the Inland Revenue Authority of Singapore, IRAS, determines that you are frequently trading stocks like a day trader, they might classify those profit as trading income, and trading income is subject to income tax. But for most of us, individual investor holding the stock as part of the long-term investment strategy, dividend and capital gains are completely tax-free. So when you're investing for growth or income, Singapore tax system has got your back. No extra paperwork, no extra tax burden, just straightforward investing. Cheers to that. Understanding key metrics and strategy. Here are 3 must-know terms to evaluate stocks. First, earning per share (EPS). Think of EPS as the company report card. It shows how much profit a company makes for each shares you own. It is calculated by dividing the company's net profit by the total number of outstanding shares. The higher the EPS usually means the company is doing well and has the ability to reinvest its profit into its business or pay dividend to shareholders. What to look for? Focus on companies with a positive trend in EPS over the past few years, meaning their earnings are steadily growing. This often suggests that they are well managed and competitive in their industry. Second, price to earning (PE) ratio. This compares the stock current price to its earning per share. It's a measure of how much investors are willing to pay for each dollar of earnings. A lower PE ratio might signal that it is undervalued. What to look for? Always compare PE ratio to similar companies in the same industry. For example, a bank PE ratio might differ significantly from a tech companies, and that's normal. Usually, the tech companies can have a PE ratio of over 100 times but still considered undervalued. Third, dividend yield. If a company pays dividend, it tells you how much you will earn as a percentage of the stock price. So for example, a 5% dividend yield means you will get $5 per year for every $100 you invested. What to look for? Focus on companies with a sustainable dividend yield and also the payout ratio. Extremely high yield can be risky if the company's profit cannot support consistent payout. There's more to the story. While these are essential metrics to evaluate stocks, they are just the tips of the iceberg. Other metrics like return on equity, debt to equity, and free cash flow can provide deeper insights into a company's financial health. To simplify your analysis, you can use free online stock screeners like Yahoo Finance or TradingView. These tools allow you to quickly compare metrics across different companies and make more informed decisions. Let's talk about strategy. There are three types of strategy in investing. First, value investing. This focuses on finding undervalued stocks with solid fundamentals. Look for companies with strong balance sheet, showing growing EPS, a stable and improving PE ratio. For example, blue chip stocks with steady dividend and financial resilience can be ideal for long-term stable return. Second strategy is growth investing. Seek companies with high growth potential. These are often in emerging sectors or industry like technology or green energy. Look for businesses with a competitive advantage or business mode, strong revenue growth potential, and ambitious projects. Keep in mind that these stocks may not pay dividend as they reinvest profits into growth for long term. Third, dividend investing. Prioritize stocks that consistently pay dividend. REITs, for example, the real estate investment trusts, are a great option, offering regular income. Look for companies with healthy dividend yield above the treasury bill rates. 4 to 6% are ideal, and a history of maintaining and increasing their payout. My take on the latest trend. So Singapore stock market is seeing growing interest in sectors like technology, renewable energy, and healthcare, alongside its traditional strong banking and REIT sectors. Trends like the shift towards green energy like Sembcorp Industries, e-commerce logistics like Mapletree Logistics Trust, and healthcare demand like Raffles Medical highlight opportunities for both incomes and growth. Banks like DBS, OCBC, and UOB remain solid choices for stability and dividend, while REITs offer attractive passive income. My portfolio, Singapore stock make up of less than 20%, mainly banks for dividend and REITs for steady income. I started with blue chip stocks in Singapore and gradually diversified into other markets like US for better growth potential. As promised, I will share with you the number one mistake new investors make. Is chasing FOMO, fear of missing out, buying hype stocks without proper research. This often leads to buying at peak prices and suffering losses when the stock price drop. To avoid this, always do your homework and understand a company business, its products, its competitions, its financial health, and the long-term potential. Stick to your investment plan, diversify your portfolio, and focus on long-term growth rather than the quick wins. Remember, missing one opportunity will not ruin your portfolio, but an impulsive decision can cost you thousands of dollars. And that's all for your beginner's guide to investing in Singapore stocks. If you found this video helpful, give me a thumbs up and subscribe to our channel for more investing tips. Got questions? Drop them in the comments. I would love to hear your thoughts. Thanks for watching and happy investing.